earnings from Tesla and Google didn't inspire investors yesterday. The US futures are in the negative this morning, while US yields are under the pressure of soft economic data from the US yesterday. Alas, the US dollar bears are quite timid these days to join in, as the rising dovish bets for other major central banks around the world will probably limit losses in the greenback. So welcome, this is Swissquote's Daily Market Talk. So the first view on big technology earnings wasn't that inspiring yesterday after the bell. First, Tesla didn't come up with blowout quarterly results, and that was not a surprise, to be honest with you. The earnings missed estimates for the fourth consecutive quarter at Tesla, as revenue from electric vehicle sales declined 7%. Now, the company's energy generation and energy storage revenue doubled last quarter, and services revenue rose 21%. But the latter unfortunately couldn't make up for the sales decline. As a result, Tesla earned $1.48 billion in the second quarter, down from $2.7 billion a year earlier, and lower than the $1.69 billion income penciled in by analysts. So last quarter, Elon Musk had come up with this robo-taxi plan that was supposed to be revealed in detail in August, remember, but that's just also delayed to October. So all in all, there was nothing to save the day for Tesla at yesterday's results announcement. So the shares slashed almost 8% in the after hours trading. And the share price will probably sit right on an important Fibonacci support, which is the major 38.2% retracement on April to July rebound in the coming weeks. A slide below this level will technically send the share price into a medium-term bearish consolidation zone, and as such increase the chances of a further downside pressure unless the techno king Elon Musk comes up with new and exciting ideas for investors about the robo-taxi and humanoid robots or so. Because Tesla will have genuinely useful humanoid robots in low production for internal use next year, and high production for other companies in 2026, said Elon Musk earlier this week. Now, over at Google, the parent Alphabet did better when it released earnings last night. The company's second quarter revenue topped analyst estimates, and its cloud computing sales rose by a better than expected 29%. Now, even though it looks strong, it's still meager, mind you, compared to Amazon's web services, which is 38% growth. So the search engine printed a 14% growth in revenue in the second quarter, believed to be partly due to AI magic, but it was not enough for investors. Google reported the smallest earnings beat since early 2023, and the little beat was just not enough to bring investors on board. So the share price fell 2% in the after hours trading for Google as well. As such, the first two of the Magnificent Seven stocks failed to create euphoria when they reported their second quarter results yesterday after the bell. So the less than ideal set of earnings will come at a time when investors are already wondering whether the AI rally hasn't gone a bit ahead of itself. And elsewhere, UPS tanked 12% to the lowest level since July 2020 as its earnings missed estimates. Wage inflation and soft package demand weighed on the second quarter results there. Then GM fell more than 6% yesterday despite a profit beat and despite raising its profit outlook on its truck demand. But another delay in its electric pickup plant didn't really please investors. Spotify, on the other hand, was the only bright spot in the earnings crowd yesterday, as their shares jumped 12% yesterday as the paid subscriptions at Spotify grew more than expected. But it was not enough for the overall market mood. S&P 500 and Nasdaq both closed yesterday's trading session with small losses, and the futures are both in the negative this morning at the time I'm talking here, because Nasdaq futures are down by almost 1% just right now. So that's it for the US. Here in Europe, well, the news earnings were much better, to be honest with you. LVMH, Louis Vuitton, which is one of the biggest European companies, actually saw its ADRs decline almost 5% in the US yesterday after announcing that revenue in China region fell 14% in the second quarter. So pretty much in line with a broad-based weakness in other luxury houses sales across Europe as well. So the situation in China doesn't really enchant commodity traders either, mind you. Copper futures are down by 20% since their May peak, while US crude cleared the 200-day moving average support to the downside without much hesitation yesterday, despite a 3.9 million barrel fall in US oil inventories last week. That could have actually slowed down the sell-off in oil, but it did not. So the next target for the oil bears stands at $77 per barrel level, which is the last major Fibonacci retracement on June to July rebound, and that was tested yesterday but not broken just yet. Trend and momentum indicators are comfortably negative right now, suggesting that the $77 per barrel support could actually be broken to clear the way for a deeper sell-off toward the $75 per barrel psychological support. In the FX, while the US dollar index was slightly stronger at yesterday's trading session, even though a weaker than expected Richmond manufacturing index, a more than 5% decline in US existing home sales, and a solid 2-year government bond auction suggested a favorable environment for the Federal Reserve those. So the US 2-year yield sank to 4.45% level, and the US 10-year yield stabilized near the 4.25% zone. The euro dollar fell below the 108.50 level as cable slipped below the 1.29 mark. Now, the rapid rise in speculative positions in sterling warned that the bullish positioning in sterling looks stretched right now, but big names like Amundi, for example, turn bullish in sterling as its FX head said he expects gains to extend to 1.35 level. Goldman Sachs also predicts further gains in sterling on brighter economic outlook in the UK and some political stability, and the expectation that the Bank of England could cut its interest rates, but less than its major peers also offers support to sterling. So a minor support is seen near the 128.70 level, and a major support to the latest rebound in cable stands at 127.60, which is the major 38.2% Fibonacci retracement that should distinguish between the actual positive trend in cable and a medium-term bearish reversal. On the flip side of the world, the dollar yen fell below the 155 mark on rising bets that the Bank of Japan could go ahead and hike its policy rate as soon as next week. Now, an unexpected decline in the July manufacturing PMI in Japan to the contraction zone certainly could have sparked a certain sell-off in the Japanese yen, but it did not, meaning that the trend now weighs heavier than the economic data into next week BOJ decision, and the trend is on the upside for the yen and downside for the dollar yen. While on the other side of the Atlantic Ocean, the loonie suffers from a sharp fall in oil prices and dovish Bank of Canada expectations. So the BOC is expected to announce a 25 basis point rate cut today when it meets, and a sufficiently weak decision from the Bank of Canada could send the dollar CAD above the 1.38 level, as the Federal Reserve cut expectations are mostly priced in by now. Now, zooming out, we could be getting closer to the time for the other central bank dose to catch up with the Federal Reserve dose, and that process could eventually slow down the depreciation of the US dollar against most major currencies. And that's perhaps why yesterday's weak economic data from the US failed to encourage a further weakness in the US dollar index and kept the index above the 200-day moving average level. But in the medium run, I expect the US dollar to reverse the year-to-date positive trend and give the global monetary policy easing era a healthier outlook. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.